Okay, good morning, everybody. I'd like to welcome you all to the Daily Energy Markets podcast. I'm delighted today to be joined by Brian Pieri, founder of Energy Rogue, Andrew Lavin, managing director of Econs, and joining us for the first time, a special welcome to Rahul Kapoor, vice president of head of shipping, analytics, and research at S&P Global Commodity Insights, based in Singapore. Thanks so much, gentlemen. For joining us. Lots to get through this morning. Rahul, maybe I can put you on the spot and start with you this morning. We have a few headlines on the bulletin today, which are kind of interesting and very much related to your specialty of shipping and analytics. One of them says that, in this month we've had 47 ships rerouted back to the Red Sea. We had somebody commenting on that earlier this week. Saying that they don't expect much change because once new routes are established, it's very costly for people to change them back again. But this looks like a different kind of headline, and do you expect that
Yeah,
we'll see more of that?
yeah. Thanks, Yola. Good to be here. So, in the bigger scheme of things, 47 ships is not a big number, right? I
Yeah.
think as we stand today, in our view, I think the Red Sea shipping risks still remain elevated. We've started seeing some ships transversing, but you're talking about thousands of ships which used to, right? I think in our data, we're not seeing much movement, right? We're tracking on the moving averages across containers, dry bulk, tankers, right? The numbers are still very, very weak in terms of what it used to be pre-routing, right? If you also look at the what we call the war risk premiums, right? They remain unchanged. And we haven't heard from the ship owners in a hurry to return to Red Sea. So it's a good headline. In our base case expectations, I think we'll need a lot more, right? I think it's probably a second half story. We're keeping a close track on it. But as of now, I would say the ships are still bypassing Suez Canal and Red Sea and going via Cape of Good Hope.
Okay, thanks, Rahul. Yeah, second half seems to be everyone's favorite in terms of at the time that we might actually start getting some clarity on so many things, tariffs from the US, trade flows as a result of that, of course, being impacted. And Brian, just to go to you, sanctions by the US on Russia and Iran, those are the two biggies that everyone's focusing on. Iran getting a bit more attention yesterday out of the US with Trump again for the second time saying, yes, we're going to, try and limit export and impose sanctions on those taking Iranian oil vessels coming into China, the OE, etc. Why? I mean, we've just talked about the last month that Trump has sort of backtracked a bit, not backtracked, but hasn't mentioned that much. Now it's Iran's turn to be mentioned. What do you make of that, and how will the market react?
Well, first of all, it's been a crazy month ever since Trump took office. There's been loads of executive orders, a lot of them centered around energy and some around government, some around immigration, government efficiency, and quite honestly, some of the things that he's signed as executive orders, there's legal questions on whether he could or should. And so there's a saying, do you ask permission or forgiveness? And he seems to be in the camp of, I'm just going to do it and ask for forgiveness later. So there's a lot of moves that he's making from an executive standpoint that are questionable, especially from a strategy perspective, such as the tariffs on Canada, Mexico, and Chinese imports. I mean, ultimately, the bearer of burden of those tariffs is actually the importer. So the American importer is actually bearing the burden of that cost. Now, there's a short-term inflationary effect on that, but long term, that should dissuade some of that energy flow. And Canadian imports were kind of discounted to a 10% tariff. I still think that's a little misguided, but that's my 2 cents for what it's worth sitting here in Colorado. But in reference to the sanctions on Iran and Russia, so these sanctions have been in place. There's been economic sanctions that have been in place, and Iran in particular has grown from 1.8 million barrels a day to over 3.2. So I color me skeptical. I do not think it's going to have any impact whatsoever unless there's actions that in my view, would be unfortunate, such as some actions of force. So I would be very skeptical of any sanction really taking root. There's probably going to be some minor impacts, but I don't think it's going to be major.
Okay, thanks, Brian. I mean, Andy, on that subject of sanctions, just sticking to that, obviously lots of talk also between the US and Russia. There's talks taking place last week on Ukraine, albeit Ukraine, but of course energy is a big part of that relationship. But again, is the market, from a market point of view, is it paying much attention to what Trump will do with sanctions, whether it's on Russian oil or Iranian vessels, or it will all remain the same and oil find its way to where it needs to go?
So I think, mirroring a little bit what Brian said, historically, sanctions on energy have proved to be pretty ineffective, especially when you look at Iran. Okay, they have found ways around it. They've found people willing to buy it because it's made economic sense. It was one of the reasons why the Russian sanctions on energy products was done very differently. It was not to take it off the table, it was to produce a price cap. And arguably that's actually worked better than the kind of let's stop it totally perspective. So sanctions are not very effective because the energies market is a global market and you have numerous players, not all whom are actually subject to those sanctions. So it kind of makes a mockery of sanctions themselves. So you then kind of work to,
and presumably, Andy, Trump knows that. And so he's using that as a political sort of statement. But of course, he wants lower oil prices, doesn't he? So he doesn't want those sanctions to work. So presumably, this is just sort of rhetoric, right?
It's, I think it's a little bit more than rhetoric. So I would come back to your first question is the oil market taking account of his words and actions, which I'm paraphrasing what you said. I think the energy market listens to the words, but reacts to the actions. So he says a lot, and I think a lot of what he says and a lot of how he says it is part of his negotiating tactics. If you offer him something for 100, he's going to say 10. And because he wants to put you on the back foot. It's the same in Ukraine. It's the same with Iran. It's the same with Gaza. Everything it's going to say, I'm going to say something that's outrageous. He's doing the same thing through Musk in terms of costs, right? Underlying it all, there's some rationale to it, right? The US economically, you could argue, is broken because it's spending too much money. It has to stop. So his tactic is, right, I'm going to cut everything. So he's doing that on the energy market. And that's why I think some of the things he says almost looks as if it's contrary to what he wants. Because as you pointed out, if he was successful in Iranian sanctions, the oil markets would go up. Well, no, he doesn't want the oil price to go up. He wants the oil price to go down. So what's he actually doing? He wants Iran back in the market, exporting volumes under a regime that isn't going to do what the rest of the world, well, specifically the US, doesn't want to do, and then oil prices will go down. He's just playing hardball.
Okay, and presumably everybody knows that. Now, the risk there is that people underestimate what might come, I think, more in the medium term. Rahul, back to you. I mean, sticking to sort of shipping, and give us an outlook from your perspective on all these uncertainties in terms of, yes, oil will still flow and not much might change, but and taking the Red Sea rerouting into account, what's the outlook for the second quarter for sort of tanker rates, if you like, and container rates, and how the market's looking at that?
Certainly, but I'll just add some facts and numbers to what we were discussing earlier, right? I think OFAC sanctions came about 2 years back. We had some of the incremental additions, but late last year, early this year, we had a major, I would say, escalation in terms of the ships which were added, right? We were looking at around 500 ships being added to the OFAC sanction list, and mostly dominated by oil tankers, right? Within that, 14% of sanctioned vessels were Russian oil flows, and almost 60%, and with today's 13 more added, I think you're looking at 65% of Iranian cargoes, right? So I think that is moving towards a bit of a squeeze on that. But when we look at the data, it's essentially the Iranian flows are facilitated by what we have in terms of NITC. But what those vessels are doing today, on the coast of China or on the coast of Malaysia, we're seeing a larger number of STSs happening, right? So you are
Yeah.
looking at masking these sanctioned vessels, right? So the oil continues to flow. Iranian numbers were slightly lower, right? Even in the last few weeks, we started seeing a bit of that oil buildup at sea as well. But the Russian numbers are not much impacted, right? There was a slight dip in there, but continues to flow even to China outside of Shandong, right? So in terms of the oil flows, those are still continuing. But we also have to understand shipping is a very opaque business, right? I think the key here is how these vessels basically reflag. They can go in and get new insurers, new traders, charters. So shipping has always been such that it facilitates some of these flows, right? And it continues to do so. Coming back, and the impact which we've seen is not on the oil markets, but we've certainly seen that on the tanker market, right? You did see VLCC rates, I think, in certain cases go up. I think we are still looking at around $50,000 per plus, almost doubling in certain cases, right? For smaller Afras and Suezmaxes as well, we did see a bump up. So what happened was traders scrambled for these non-sanctioned vessels, and when you're bringing them from the compliant fleet, you have to pay more. So the tanker market outlook has slightly turned for better, right? Despite OPEC not increasing exports, right? So the oil is not in terms of how does the tanker market work? It needs more volumes to flow. We're not seeing much more volumes compared to the last year, but we are seeing much more demand for these non-sanctioned vessels from the compliant fleet. So that's why the oil tanker outlook is better, and better, I would say, for the dirty tanker market or the big ships, for certainly for the VLCCs. Uh,
Okay, all right.
Yeah,
Yeah,
go ahead.
thanks, Rahul. Yeah, I mean, I'll come back to you. That's
Sure.
interesting. I mean, Brian, back to you on that front. I mean, let's talk a bit about sort of global supply and demand. We'll get to that. But yes, from a supply point of view, Brian, we've been talking a lot about sort of non-OPEC supply in the last year as OPEC Plus continues to hold back volumes. The US obviously being one of those, and we've had a lot of your sort of expertise comments on that and your opinion that that's not going to shift too much. What about other non-OPEC supply? Let's get your view on that. Sort of from South America, the likes of Brazil, Guyana, and will those make more of an imprint, do you think, this year than they did last year?
Well, let's see. When we look at last year, we saw a little bit of growth from Venezuela, but a large chunk of the growth came from Guyana, and these are going to come on in kind of chunky pieces. So these, I wouldn't expect anything in the first half to really surprise out of Guyana, but probably second half. Maybe 300,000, something like that. Venezuela, maybe you see 100,000 there. The US maybe another 100,000, and Canada probably another couple 100,000. I think OPEC in their monthly market report, I think estimated about 1 million barrels a day, maybe slightly more coming from non-OPEC supply, and I think that's pretty close. But I think these countries are going to fall short of that, and then it gets into the question of that I saw Sean's London video this morning where he talked about 2025 being really a supply story, and with OPEC holding barrels off, it is going to be a question of you have non-OPEC supply, maybe 600,000 to 700,000 for growth for 2025. That's what I see. Then you have OPEC barrels off the market. Then you have sanctions on Iran and Russia, and these are the chess pieces around the globe on a supply basis. So what I'd see is that if sanctions took place in Iran, that Saudi Arabia would probably fill that up, plus the growth that is expected from UAE that is currently constrained back. So that's kind of what I'm seeing.
Okay, so Saudi and the UAE are the marginal suppliers in this equation at the moment, standing by. Andy, back to you on that. I mean, OPEC Plus, though, in a month's time, has pledged or planned to start to at least put some barrels back. Should we dismiss that that's going to be possible now and say, okay, again, it's a second half story?
So I guess it depends whose tune they're dancing to. There is an argument to be had that said, let's actually open the taps up a little bit because then we might placate the US. So the US then may be less enthusiastic about bringing Iranian and Russian barrels to the market. And I think OPEC will find itself in a very difficult position, because if you've got new non-OPEC barrels coming to market, if the Ukraine-Russia war is stopped, then there's going to be more Russian volume that comes back because their economy is going to start picking up. If, as I said earlier, Trump is successful in getting Iran to accept some very strict terms in relationship to allow them to re-export, what does OPEC do? You then have a whole bunch of demand of supply come back, and they're faced with falling prices. So their only mechanism is to cut production again, which is going to be very, very painful. So they're walking a tightrope in terms of what they should be doing. So I think you could see them pausing and keeping the cuts, but I also think you can see them saying, well, it's not just yet, but we see it coming, therefore we're going to open up a little bit. And it depends on the politics.
Yeah, absolutely. The politics, exactly. Politics versus price. But what about compliance, Andy? Just sticking with you, because we've seen sort of differing, well, better compliance overall, let's say, as we ended the last year, but then we started to see more Kazakh crude in the last few weeks come out, and Iraq, another bulletin headline today saying, oh, it's going to comply better. So, you know, compliance is still a bit of a seesaw, isn't it, from certain members? And do you think, does that matter really at the moment, or is it just price? They're just focusing on keeping the price above 70.
I think they've got bigger things to worry about than short-term compliance. I think OPEC as a group are never going to be 100% compliant, because individuals will have different production profiles. Individual countries will have different demands in terms of their economies. And there's always going to be this balance between compliance and pushing the boundaries. So I think their focus is, where are we going with this, and how do we not box ourselves in a corner?
Okay, thanks, Andy. Rahul, I'd like to go back to you and talk a bit about just the US tariff story in general. I mean, not just on energy, but how it impacts shipping and shipping costs, obviously, and therefore, you know, obviously manufacturing costs, etc. in the US. There's another story, and I had a bulletin today about the US port fees, another one of Donald Trump's moves of, you know, port fees on Chinese vessels, obviously carrying another tariff, really. I mean, everybody's saying this is only going to impact US manufacturers and importers negatively and no one else. How is the shipping community looking at the tariff story? Can it prepare for it or, you know, or just respond ad hoc?
Certainly. So I think particularly on the tariffs, right? So this has been there since 2016, right? But what we saw that time and what we're still seeing today is there is a bit of what we call supply chain diversification. But where is that going to, right? That's probably going to Mexico, Vietnam, or India, right? But at the back of it, there's still a lot of Chinese investments which is being done there, right? So the flow of goods is still there. A bit of that tariffs are being circumvented, but whenever we see some of these tariffs come in, the trade route shift, right? That will continue to happen. But at the end of it, I think we've said this before as well, China still remains a manufacturing story in terms of a domination in terms of manufacturing. And it's just that at the margin, you started seeing some of those global supply chains move away, right? And in the end, I think Andy mentioned that, I think it was Andy who mentioned, but it's the consumers who have to pay, right? So we will continue to see that. But protectionism for China, for the shipping industry, is the latest USTR. I think that is something which is not being talked about much, particularly in terms of port fees. And what US is essentially doing here is, for the first time, taking a stab or putting the Chinese maritime dominance under scrutiny, right? China, over the last 15, 20 years, has built one of the biggest global merchant fleet, right? Whether it's tankers, whether it's containers, now also in gas, right? And dry bulk, certainly. And also the shipyards, right? Just to in terms of numbers, right? If you have to build a ship in the US today, that will cost you 5 times more and probably 3 or 4 times in terms of the number of years required. So I'm not sure where it is going with that. It will be highly negative for the global supply chains, global trade, and for the US trade as well. If you take out the US or the Chinese built ships, or if you start putting $1 million port fees on them, it does have a major impact on the global trade, right? So in our view, unlikely to happen. That's under proposal and accepting comments until March 24. But it's something which has come for the first time in terms of US targeting the Chinese maritime dominance.
Yeah,
So
yeah.
lots of things happening on that front.
Okay, thanks, Rahul. Brian, let's talk a bit about LNG, US LNG, because of course the other thing that's been happening the last week is, the US has been saying it's going to bring the Russia-Ukraine war to an end. I think a lot of the market believes it will happen by the summer, one way or another, and to certain parties' advantages more than others. But of course, we've seen a lot of Russian gas, well, some Russian gas being replaced by US LNG into Europe. Not all of it, obviously. How do you think the US LNG market's looking at this prospect of Russia coming back and some of Europe ultimately taking more Russian gas? Will it impact US LNG, do you think?
I think it will. It's probably going to impact more trade flows as far as where the LNG goes, because LNG in the United States roughly accounts for, say, 15% of the US supply of natural gas. So we produce roughly 103 BCF a day, and we export 16 BCF. But we are set to increase another 3 to 5 BCF a day this year. And when you throw in another wrinkle into that, Canada is going to be exporting another 2 BCF. So the United States has an interesting dynamic on the natural gas market where we're going to have less imports from Canada. Disregard the tariffs. This is just from Kitimat LNG, which is on the western coast of Canada. That is going to be going to Asia. And then you have 3 to 5 BCF of capacity opening up. So the key question is, will that capacity actually have enough regasification destinations in mind? And the piece that you're mentioning is Russian gas coming back into Europe. Well, Europe does have a memory of Russia turning off some valves and turning off gas in particular countries like Poland in 2014. Like there's a memory there of not really sure if they can trust the counterparty, where they may pay a little higher for U.S. counterparty because there might be a little bit more quality concern of deliverability. So I would say the key question is that as the U.S. goes from 15% of our production being exported on natural gas to 20% or 22% over the next 12 to 16 months, how much of that is going to be filled with regasification? Because now you have to pace not just the exports, but the regasification. So how much regasification can take it back in? And I think that's going to be the key constraint there. And I don't think it's really going to impact I would say probably 80% of our export capacity is going to be full this year, whereas we're currently probably closer to 95%. So that's probably what I'd say.
Okay, thanks, Brian. There's also a question about an oil price outlook for the end of the year and where our audience might see that ending. Not averaging, but where will we be at? What range will we be at by the end of December? So we'll look forward to seeing what everybody's. That is a long way out. Obviously, so many things can happen, but let's see what people's opinion is. Andy, let's talk a bit. I mean, sticking to sort of Europe, but not necessarily gas. The refining globally really is kind of under pressure, maybe not so much in Asia, but European refining has really had not had a great few months, has it? And with the sort of whole manufacturing negativity, also activity that the European economy is also undergoing, that hasn't given refiners a boost either, has it? So outlook for European refining in the second quarter, margins, could we see an improvement? And how do those compare versus Asia, for example?
Good to be. I mean, on average, European refineries, and I would include in that the UK refineries, are old. They're not, on average, particularly sophisticated, and they have been left and unimproved because of the global flow of products, because it's more efficient. And so now they've got this challenge. So in the longer term, the reality is they've got a choice to either we've got to build and invest, or we have to accept we're going to be importing. In the short term, I think if the US-Ukraine crisis starts to wind down, if you start to see more crude and crude starts to fall, then they'll probably see a benefit to refinery margins, but it's going to be short-lived. I mean, you saw the UK government announcing 200, I think it was 200 million pound fund for the Grangemouth refinery. Ultimately, if you go out 5 to 10 years, the majority of European refineries are going to be shut down because there are more efficient refineries elsewhere in the world. That is something I don't think is ever going to change. It's just how painful is the journey of the European refiner.
Yeah, well, too little, too late, maybe being done. But yeah, maybe. I mean, those operators have to make decisions, don't they?
Well,
About
the problem is it always comes back to economics, right? So the reason why money was not being put into European refineries is because Asian refineries are cheaper to run, and it's therefore cheaper to get products. So part of the challenge we're facing at the moment is a lot of the things that not just the US is doing, but other countries are starting to do now, is trying to rewrite economics and say, no, we have to do things at home. And I get why you want to do things at home, but the reason why they weren't being done at home is because you were too expensive. So actually, it's not sustainable to push back against basic economics in the long term.
Yeah, and the basic economics is that Asia is cheaper for most things, including manufacturing, and that's something the US may have to face at some point. Rahul, thanks. Thanks very much, Andy. Rahul, back to you. Let's talk a bit about the dark fleet, because we've obviously that's still going. You've got the grey fleet, the dark fleet, but just more about a regulation around that. I'm wondering if you have an opinion on, there were more stringent sort of measures that came in at the end of last year on that, with it, through insurance and different sort of tools, and a call really for better monitoring of the dark fleet. Is that a possibility, do you think, in the shipping world, or
It's
not?
extremely difficult, right? I think if you look at what's been happening, and the challenge is, how do you mask the ownership? How do you mask the classification society? Flags of convenience, right? There are 4 or 5 layers of who the actual owner of that asset is, or actual owner of that ship is, right? By the time you get to sanction that, within the next 1 month, they change ownership, they change flags of convenience, they change the new operator, right? So we essentially track that within our data, and what we are looking at is almost 2,000 vessels, which we call at-risk vessels, right? And these have been involved with certain ports where they've discharged, carried Russian, Iranian oils. Might not be part of the sanction list today, but we're talking about 2,000 vessels which are in that dark or shadow fleet or are at-risk vessels, right? So it's extremely difficult. Shipping has always provided for decades that outlet for some of these flows, and will continue to be, right? And earlier, like we said, we wanted the oil to flow from Russia, but without the dark fleet or the shadow fleet, there was no way oil to flow. So very difficult to say how do we monitor that, despite the
Okay,
tools being there. Yeah. And just one last point, right? I think you're talking about the LNG, right? So I think the fact is 30% of those new LNG tankers are being built in China, right? So if the US comes up with that port fees, or for that matter, non-Chinese ships, I think that impacts the economics of the LNG exports as well.
Okay, thanks, Rahul. Andy, actually, I'm just going to go back to you, because there is a headline I just wanted you to address on BP in our bulletin, which is BP set to scrap renewables energy goal as it boosts oil and gas. Of course, we've seen a lot of the majors and European majors, as well as the US ones, kind of backtrack a bit on their sort of ESG green investment goals, openly and happily declaring that in the last 12 months. BP being one of those, obviously. Is that sort of a trend that's not going to reverse back again, do you think? I mean, we've kind of, are we moving away from, are majors seriously moving away from their renewables transition goals?
I think it shouldn't be, but sometimes strategy is a bit of a pendulum, right? And I think because of the re-election of Trump, and because of some of the things that he is saying he's going to do, the pendulum on net zero, the pendulum on green investment has most definitely swung the other way in a big way. And therefore, what you're seeing is a lot of companies backing off and saying, okay, well, I'm going to do this because it fits into the current economic climate. You've seen Apple turn around and say, we're going to do a $500 million investment in the US. Well, why are you going to do it now when you weren't going to do it a year ago, right? So everybody is reacting to the current environment. And I think the oil companies, and I said for a long time that I don't believe the old oil companies were ever really set up to be truly successful post-energy transition. Their expertise is in oil and gas and producing and refining. It is not in creating renewables. And actually, the reality I feel is that the new companies need to come along and say, actually, we can make this economic. And that's the problem, because a lot of the current attempts to make wind farms, solar energy, etc., truly economic are being attempted by people who kind of say, well, I can make these numbers are wrong. I can make the equivalent of $10 a barrel producing and refining, or I can make $3 a barrel on a wind farm. Oh, but I've got to do $3 a barrel. Why? That doesn't make any sense to your shareholders. So you're starting to see that flow through. Whereas actually it's like, well, hang on a minute. No, my true cost to this is X, and therefore I can make $10 here, but I can make $12 here in the long term because I've worked out how to make it cheaper. I've worked out how to use this in a much better way. And I don't believe the capability exists in the current oil companies.
Okay, thanks, Andy. I'm sure Brian would agree there on the US company front that they never sort of took the steps that the European majors were taking anyway. But companies like Exxon, etc., just full throttle ahead oil and gas and haven't even really pretended to do otherwise. Thanks so much, everybody. Thanks, Andy and Brian and Rahul, for joining us today for the first time. There's the result. 65 to 75, which is kind of where we haven't dipped below 70, but we're in the higher end of that range at the moment. But no one really confident will go much higher than that by the end of the year. Thanks, everyone, for joining us, and have a good week ahead.
Thanks so much.
Thanks, guys.
Thank you.
Bye.